We provide safe and secure payment processing and client services with reduced rates and improved services to feed charity, community, and small businesses. We are at williamseford.com, and we are Williams Eford Digital Processors. I am RJ Williams. Thank you for joining us. You see, given the current climate for industries with regards to an increase in everything, it seems, that we need to produce products and services for the marketplace, I am in the pool of responsible stewards in this industry, poised to raise the proper level of awareness regarding payment processing, the different trends and developments that we're seeing in the industry, in particular the high risk merchant space, and just everything, payments. Okay, and we thought that a great way to do that would be to produce a series of videos that gives you an overview of the building blocks of payments. Because with everything that's going on with the different hacking and data breaching that we're seeing, the different needs of different industries and sectors within industry that have specific tools to effectively help them run their particular type of business. There are levels to a payment operations. Payments are built, so we want to take you through these building blocks of payments. This very first video we'll be talking about a little bit about merchant account access, but in particular we'll be talking about rates and how merchants are charged and what that looks like. And hopefully we hope it provides some insight for you moving forward in planning and calibrating your payment operations. So let's go ahead and get started with the basics. You have a customer in your store, and each time that customer swipes or dips or taps a credit card to purchase a good or a service, the merchant's going to receive, of course, their total amount of the transaction sale in dollars, minus a small percentage that goes over to the issuing banks and the card brands. Okay, this is called a discount rate. Discount rate, again, in the form of a percent of a sale charged by a merchant account provider, which would be us, to its clients for processing services, plus interchange and assessments, which are paid directly to the card brands and issuing banks when a customer swipes, taps, or dips their card for payment, more loosely known as a card swipe fee. Let's lay this out for you. That card swipe fee, or the discount rate, has two parts to it. Okay, the interchange rate that is set by the card brands, and the processor servicing side, which is a fee paid to merchant banks and processing agencies such as Williams Eford to facilitate that transaction. So the authorization, authentication, and settlement of that transaction is what we provide and solely provide. Okay, and provide the instruments for merchants to accept those digital payments. So like the POS systems and card terminals and everything of the sort, payment gateways for online e-commerce and all of the sort. Okay, there are some things that affect that card swipe rate or that discount rate, and we'll talk about a couple of those things moving forward in this particular slide or this particular presentation. But let's go ahead and talk about the interchange rate and break that down, because the interchange rate itself has two parts. Okay, it's set by the card brand networks and represents a base fee or a wholesale cost of accepting electronic payments. Okay, this fee is what the acquirer pays, our merchant bank partners, pays the issuer. Okay, and the rate varies depending upon the industry type, the type of business, if the card is a present or not, if the card is present or not present at the time of the transaction, etc. The interchange fees are different for each card type, and the rate is higher for points and rewards cards. So when you see those commercials with the famous actor on it that ask you what the contents of your wallet and talks about cash back and what you get back, those actual rewards programs are paid by the merchant via higher card swipe fees for those particular cards once they come over. The second part of that interchange rate is a cost per transaction assessment fee. It's an amount charged to the merchant each time a communication happens between your software or point of sale terminal and the authorizing network. So the processing servicing is what makes up that authorization fee. Okay. The communication can occur either over a dial-up telephone line, a leased line, or the internet, and this fee covers all transaction types. So not only sales transactions, it'll cover post-authorization transactions and refunds. On average, you can find that this particular fee is between 10 cents and 25 cents per transaction for low-risk merchants. Okay, let's go ahead and talk about some of the different things that go ahead and make up the or that affect the interchange rate, I should say. Okay. So again, keyed versus swiped. If you swipe or dip a credit card, the credit card holder is assumed to be standing in front of you. You can easily verify the identity by asking to see their identification card or checking the signature. If it's a debit card transaction, that's all circumvented by them putting in a dedicated, personalized 4-digit PIN to authenticate that sale on their end. With manually entered transactions, you could be entering the card information over the phone or the internet, making it harder to verify that you're accepting payment from the owner of that card. So this riskier situation, it makes credit card networks nervous. So they put measures in place to protect against such transactions, such as higher interchange fees. Okay, the card type. Okay, again, cards that earn rewards that carry a higher interchange rate than standard credit cards with no rewards. Okay, products and services are characterized as either low or high risk transactions and are given category codes to differentiate between the degree of risk that exists between transactions of all industries. Okay, then you also have what brand or network, card brand or network, um, the card belongs to. Either Visa, MasterCard, American Express, or Discover. Because American Express and Discover issue their own cards or traditionally have issued their own cards, their own bank or financial institution, those particular interchange rates are higher, much higher than Visa and MasterCard. So the type of card, along with if it's a rewards card or a standard card, that all comes into play. And again, talking about card present or not card present. Okay, card present again, making a restaurant purchase, purchasing a candy bar in store, that is a lower risk transaction than if they were buying that candy bar online, where the card's not present and you cannot see them. And again, interchange rates are established solely by Visa and MasterCard, American Express and Discover, and are not negotiable. Okay. So the first part of the discount rate is established by the four card brands, Visa, MasterCard, American Express, and Discover. Those rates are made public and they are passed through as a wholesale rate to the issuing banks, who then pass it on down to processors like myself and our merchant bank partners. Okay, and then we go ahead and do our processing servicing on it. We facilitate the authorization, authentication, and settlement of that card transaction. And you swipe cards all the time. So that 20 seconds that you're waiting for that to be approved for that particular transaction, that is what we handle here at Williams Eford. Okay, and this processor servicing represents the second part of the discount rate. Okay, so let's go ahead and talk about that a bit here, if we shall. Thank you guys so much for staying with us here. Now, merchant banks and processing providers, they apply their fees to the interchange rates that are passed through from the card brands. Merchant banks and processors then process their services using different pricing structures, and we're going to talk about those right here. One of them that's out there is called tiered rate pricing. It's a method used to help processors assess how much they will mark up the interchange rates to represent the total discount rate charged to the merchant. Giving you an example here of what a tiered pricing model looks like. What they'll do is they'll group certain credit card types together, used to make they'll group certain credit card types used to make purchases together into three separate tiers. Transactions with a lower interchange rate charged by the card brands are labeled and tiered as a qualified rate. Okay, the next highest interchange rates are grouped into a mid-qualified rate, and the transactions or cards that are used with the highest interchange rate that come across from the card brands, they receive the highest markup and are labeled as a non-qualified rate. Now we'll venture into these different tiers and what have you in a future presentation, and why we believe that the tiered rate pricing is the most expensive of the pricing structures. But we'll definitely go ahead and go through that. But as you can see here, the cards that come over, we talked about those preferred cards, those corporate cards, those business cards, okay, the ones with the rewards and what have you. Take a look at that non-qualified rate. You see what the processor markup is. It's typically higher there, except if you take a look at the top at the different, at the very top there, the qualified rate. For retail debit, regular retail debit cards, the processing markup is higher there than it is for a corporate retail card if it's used for a transaction. But again, we'll get into that later on. The most widely used payment providers in the space, the names we all know, they use a flat rate pricing structure, and they market this structure as easy and the most affordable with no confusing fees and ancillary charges, with a quick and easy activation process. One primary concern that we have with flat rate pricing is the considerable amount of markup these payment aggregators place on top of the interchange rate, and that the perceived value they create does not justify the inflated markup on the interchange. Okay, most of these options are they're good short-term solutions for merchants who need a quick and simple activation of processing service to start taking cards right away. But as businesses scale and require more applications to effectively run businesses and payment operations, this high flat rate becomes too high of an operating cost for many of our industries out there. Okay? These options also do not provide merchants with an actual merchant account, with an actual merchant ID number, as there's no actual vetting and underwriting involved in qualifying the merchant on the front end. Instead, this underwriting takes place after the merchant begins taking payments and the transactions are analyzed to determine if these processors can maintain those hefty marked up margins. Okay, so depending upon your industry and dealings, these payment aggregators, some that you see here, have instantly shut down a firm's payment operations without adequate enough warning for the companies to seek other processor options, which can be catastrophic in some instances we have witnessed firsthand. Okay, Interchange Plus is what we love to use here. Interchange Plus is a pricing model used by credit card processors to determine the per transaction cost paid by merchants. The model consists, you guessed it, of two parts. The interchange fee, of course, determined by the card networks, and the processor servicing markup set by the card processor itself. Now, I wanted to use, as I mentioned earlier in this presentation, I wanted to give an example of a high-risk merchant or a high-risk industry. So in this example, I'm giving you that taste right now. So the most transparent and easy to understand pricing structure is Interchange Plus. Interchange rates are made by the public. You can go take a look at those right now, as Visa and MasterCard and American Express and Discover, they do post those. So the pricing is presented in the form that discloses how many basis points, okay, is being added to interchange. A basis point, 10 basis points is a tenth of a percent. 100 basis points is 100%. So what I wanted to go ahead and show you in this particular instance, in the collections vertical, so your collections companies considered high risk, okay? So you can see the interchange that comes over, the 1.8 plus 25 cents, and then you'll see 105 basis points or 1.05% added on top of that for processor servicing. It's because it's a high risk vertical. Okay. Now, what I want to show you under this is because it's a high risk vertical, and depending upon the sector of collections that we're talking about, the type of collections agency it is, there's even an additional sponsor fee that's added on top of that processor servicing. Okay. So, as you take a look here, if we're talking about a repayment first party collections agency, there are 40 basis points that are added on top of that interchange, okay? And if you're talking about third-party collections or debt buying, 55 basis points are added on top of that. Also on the authorization and settlement transaction fee, we say we're typically for low-risk industries, it's 10 to 25 cents per transaction. But in this particular instance, you can see 30 cents per transaction added on top of the interchange that comes over. So in this particular instance, you could realistically see a per swipe card transaction fee or a discount rate of 3.40 plus 55 cents for your higher risk transactions. So we just want to go ahead and give you guys an example here. So merchants may be considered high risk, by the way, if they have a high volume of transactions or have a high average transaction rate. Okay, if a merchant processes over $20,000 in payments per month, or has an average transaction of $500 or more, for example, they may be classified as high risk. Okay, an industry with a history of chargebacks or the frequency of returns, sheer industry reputation like the cannabis industry or the merchant's credit score even. That also can have a factor on whether or not an industry is high risk or not. So definitely want to take you through that Interchange Plus, but of course there is something out there that is called cash discount that would completely eliminate interchange fees. But we'll definitely go ahead and get in another conversation and another presentation about cash discount because it is a very, very cost-effective way for many of our industries to defray the cost of payment processing, as it can get very, very expensive for many, many of our industries. Now, what I wanted to let you guys know before we go, I mentioned at the outset that we are seeing a crunch. We're seeing a crunch in the increase in raw goods and services, all the things that it takes for us to run a business. Everything is increasing, including the interchange rate that I talked about. So this April 2022, Visa and MasterCard will raise their interchange fees across the board for most verticals and merchant categories by 20%. Now, this was supposed to happen originally in 2020. This was supposed to happen. They were going to establish this, but then they decided that they were going to go ahead and postpone it to 2021 on their own. When April 2021 came around, we had a lot of senators and a lot of folks in the legislative branch up there that pleaded with the card brands to not make these increases go into effect in the height of a pandemic. So they agreed to postpone it again to April 2022. So that is where that's where we are right now. So this is affecting all of our different industries, and we want to let you know here at Williams-Eford, we are hard at work to provide you guys with a no obligation cost savings analysis of your company's merchant processing statements. We want to demonstrate an amount of cost savings suitable enough to offset this upcoming increase. So we definitely want to go ahead and invite you guys to come out or to visit williamseford.com. Check out more information there about our services. A lot of the different industries there that we service are there with additional information. We'll also be adding some information about our high risk merchant processing, and we'll be doing some presentations on that. But as far as to go ahead and get started, and if you want to see how much your company can save, you can go ahead and submit a merchant processing statement right there directly on williamseford.com. If you scroll on down to the bottom of that page, you will see a tab that will allow you to go ahead and fill out a little bit of information and upload your merchant processing statement. Your most recent one will suffice. And for those Square and Stripe customers and other payment aggregators in which your processing statement is an actual summary, we are able to go ahead and provide you with a cost savings analysis on that particular summary. Okay. So yes, WilliamsEford.com is here for you. Williams Eford Digital Processors is here for you. PCI compliant hardware and software, white glove care and support from Swipe the funding, and of course, we'll be also doing some videos on our You Swipe, We Share initiative, as monthly residual donations will go to your favorite charities just for being our client here at Williams-Eford. I thank you guys so much for joining us. Please go ahead and reach out to me, askrj@williamseford.com. You can set up a 15-minute consultation meeting with me right there on williamseford.com. Upload your merchant processing statements. We'll be seeing you next time on the Fee Fighters channel with a talk on cash discount. You guys have a great one now. Thank you so much for watching.